Hi, everyone. Welcome to another episode of Bits and Bips, the interview, the show where we explore how crypto and macro are colliding one basis point at a time. My name is Steve Ehrlich. I'm the head of research at SharpLink, and I'm also your host. We've got a lot to talk about today. We're going to focus on the massive hack that impacted KelpDAO and Aave. But before we do, just a quick disclaimer, nothing that you're going to hear on today's show should be considered financial or investment advice. For full disclosures, please see unchainedcrypto.com/bits and bips. And finally, before we begin, let's just take a brief moment to hear from some of the sponsors who make the show possible.
If you've been loving Bits and Bips, don't forget that the show is transitioning to its own feeds on X, YouTube, and your favorite podcast player. If you're not already subscribed to Bits and Bips on its own channels, go there now and hit that subscribe button so you can keep up with our twice-weekly live streams and Macro Meets Crypto breakdowns. Bits and Bips will only be on the Unchained feed for a few more weeks, so subscribe today to be ready for launch. You can get all the links at unchainedcrypto.com/bits and bips.
All right, welcome back. So all of us have been sort of pondering the implications of the massive hack that impacted KelpDAO and led to almost $200 million in ETH being borrowed, being taken out of Aave over the past couple of days. It's led to a tidal wave of outflows. Over $8 billion worth of assets have left the DeFi blue chip. And the industry is really pondering the implications, not only for how this is going to be resolved, who's going to be left holding the bag, but then also what does this mean for DeFi in general? What does it mean to be trustless and decentralized? And how can sort of DeFi recover and move forward in a world where we're going to see more TradFi institutions coming online, RWAs coming online, and expectations of just massive growth in the industry as stablecoins continue to expand. A lot has been written about this hack and trying to distill exactly what happened. Blockworks Research published one of the most rigorous postmortems that I've seen so far. It kind of goes beyond just the mechanics of what happened, but also raises some important questions and answers some of the thoughts that are running through my mind, and I'm sure plenty of yours, as to how the industry, again, is going to move forward. And it also raises some hard questions that I think we're still waiting to get answers to. So I'd like to bring in all three authors of that report so that we can explore it in more detail. First, we have Luke Leisure, the head of research at Blockworks. So welcome, Luke. We have Chandra Devens, research analyst at Blockworks. And then last but not least, we have Carlos Gonzalez Campo, another researcher at Blockworks.
Hey, happy to be here.
So welcome, guys. Chandra, let's just start with you. I know our audience, it's pretty sophisticated. Many of them are on top of what's been going on. But for anyone who has not been up to date on the details, can you just briefly explain what happened, why it was such a sophisticated attack, and if there's any sort of like last minute updates or news events that have transpired today? I would love to get those as well.
Yeah, sure. Thanks so much for the intro. Our research was primarily focused on how the exploit affected Aave, but just for some context of what the exploit actually was, there was an attacker who signed a malicious cross-chain transaction exploiting Layer 0's DVN network, and that malicious transaction claimed that 116,000 rsETH was burned on the L2, which allowed that equivalent amount to be minted on the Ethereum mainnet. The attacker then took those funds, split them into various wallets, deposited them into Aave v3 as collateral, and as an exit strategy, borrowed 93% LTV against that position, leaving the protocol with around 193 million in debt taken away. So following this, there was a lot of people withdrawing funds from their wrapped ETH position. So we saw the market go into around 100% utilization. Borrowers could not take their collateral back anymore. And instead, as a kind of synthetic form of exit, they borrowed stablecoins against their wrapped ETH position. So now the situation that we have is there has been ETH withdrawn from Aave. Wrapped ETH markets and stablecoin markets are at 100% utilization. And normally the dynamics of a lending platform would be that with high utilization, you have higher interest rates to incentivize borrowers to step in and provide liquidity and for lenders to pay back their loan. But just due to the uncertainty of how this bad debt is going to be handled, we're kind of stuck at a standstill. 100% utilization, lenders cannot withdraw their funds.
Yeah, it almost seems like one of the circumstances where price, like interest rates, just didn't matter because it almost sounds like a binary outcome. Either you get your money out or you don't. You don't even care what price. Again, I know your report focused more on the Aave side of things, but I do want to kind of get your thoughts and anyone else like Luke or Carlos. Like, I'm not an expert in bridges. I'm not an especially technical person, but it seems like the setup, and I know this has been a point of contention between Kelp and Layer Zero. It seems like it was a one-of-one type of signature scheme that was necessary to create that sort of fraudulent transaction. I know from what I've heard, it seems like Layer Zero says that's sort of like the default baseline, although they recommend a more sophisticated type of multi-sig. KelpDAO obviously went with baseline. It seems highly dangerous to put that much money in the hands of essentially one signature. It's funny. I don't know if any of you guys have ever watched the show Seinfeld, and I know I'm probably a bit older than you are, but there's one famous episode where George Costanza is trying to break up with his girlfriend, and even that required a 202 signature because he tried to break up with her, and she said no, and they were joking that it shouldn't be as complicated as launching a nuclear missile on a submarine where both people have to turn their keys. But it seems like it was much simpler here not simple in the sense that it was simple to implant the fraudulent messages, but in since you really only had to compromise one signer. So I'm just curious your thoughts on that.
Yeah, I'd say there's certainly some fault to be shared across the board here. Kelp with over $1 billion in client deposits can do better than a one-of-one. And certainly we know at this point a one-of-one is pretty frowned upon. Then of course, Layer Zero, who had their off-chain RPC infrastructure compromised. Perhaps they shouldn't allow the one-of-one to be the out-of-the-box kit for new deployers on the OFT standard, and perhaps push back more. I think the numbers show close to 40% of those unique OFT deployments are on that one-of-one.
Really? So you're saying that 40% of people that use this infrastructure still have that one-of-one?
Not of total capital, but of unique OFT deployments, and a number have since been upgraded as well following the exploit. And
hopefully,
we saw a lot of unique asset issuers who run the Layer Zero OFT. They had to freeze their infrastructure as well to evaluate any compromises on their end. And then third, downstream for Aave, when listing the rsETH as collateral, perhaps of course the one-of-one signer on the OFT deployment that could have been flagged as a risk for the collateral listing, and parameters adjusted accordingly for that.
Yeah, you would think. I mean, I know I think in this conversation we'll get to things like circuit breakers or rate limiting, but yeah, all those things certainly could have helped. So Chandra, back to you. Want to focus on Aave, and there's different levels of I guess knowledge about how these DeFi platforms operate. I mean, to a certain baseline, like how they function, but then also how they're used. And your report does break out some delineations. I mean, Aave, sort of their implementation on mainnet Aave version 3, which is the main pool, the blue chip pool that sort of like commingles all deposits, and that's part of what makes it a very powerful platform for DeFi participants to use. But then it also kind of socialized this risk that the extent of which was unknown. I'd love for you to just explain the design choices that went into that. But yeah, let's just start with that. I mean, why did they choose that setup? And then I have a follow-up.
Sure. So this kind of ties into modular versus monolithic lending. And it also ties into a very interesting point that we made about looping and its impact on the severity of the attack. So with protocols like this, you have two sides, right? You have the lenders that are supplying their collateral, and that gives them borrow power to allow them to borrow assets against that collateral. But in this collateral pool, assets are all pooled together, and there's no distinction between what assets are allowed to be borrowed against it or different rates of interest rate. So normally under a lending setup, you would expect if I were to deposit ETH in the protocol, you expect a very diverse set of lenders using different collateral at different loan to value ratios to borrow against that, right? I might have one fund that has deposited Bitcoin, borrowing my ETH, some users depositing stable coins. But when we look at the actual user behavior on these lending platforms and we think, why would someone borrow ETH as an asset? There's only one real reason, which is to go short that asset, right? To borrow it and then sell it on the market. So we don't really see much organic behavior borrowing ETH. We see a lot of people using it as collateral, depositing to borrow USDC, but we don't really see much organic borrow demand. And an example we can give here is Wrapped BTC, which is another market. That has a utilization rate of only around 4.8% at the moment, and it's extremely cheap to borrow, around 40 basis points per year. What we're seeing instead, the type of behavior is people taking these pooled reserves, right? Because ETH can be borrowed and there's no distinction between what collateral types are used. And we see a lot of leverage looping, which is the activity of a user using an active staked version of ETH that generates yield to borrow a passive wrapped ETH version of it, converting that back into the active asset that generates yield and looping that back and forth. So that is basically the primarily use case of using this wrapped ETH in the pool reserves. And when we looked a little bit deeper, we saw that around 98% of collateral backing these positions, the wrapped ETH that was borrowed, was in these LSTs.
Yeah. Yeah, it's interesting. I mean, the looping idea, it's something I've been familiar with for years. Anyone who actively follows crypto is aware, because it's just a very simple way to get leverage. And when things are going well and the numbers add up, it's a sort of a market neutral way of juicing returns. But it can be dangerous. I mean, for one thing, I don't know how much people understand the way these markets work, but just because when you borrow money, my understanding from a platform like Aave, you borrow at a certain interest rate, but it's not fixed. It's variable and it can change. People can get caught on the wrong side of it. And then it leads to rapid deleveraging and real problems getting out of these leveraged positions. But then also, I wonder too, I mean, this looping, do you think it constitutes any real economic activity, or is it just a way of getting excess leverage? And to what extent does that sort of just, what's the word I'm looking for? Like warp like incentives and sort of risk guardrails?
I mean, I guess it would depend on your definition of real economic activity. I would say it is real economic activity, right? Because without this looping demand, ETH would have no utilization. The looping traders are borrowing ETH, which increases the utilization. It also increases the interest rate for the lenders. So when you deposit ETH onto the platform, I think you would have historically earned around 1.7% APY versus the example of Bitcoin that I gave, where you earn 0.01 because no one's borrowing it. So it is generating economic activity. A lot of demand, a lot of use from lending platforms is this looping. The question is just, does that kind of obscure the risk that you're taking on as a lender when you believe you're depositing into this diversified pool, when in reality, 98% of it is just running this trade? But I would say that it does constitute real activity.
Fair enough. And I know in your report, you also pointed out that the majority of the wrapped ETH debtors are concentrated in like the top 10. Did you have any sense of who those people are? And I guess do you know who they are?
Yeah, so we did take those wallets and we just ran them through Arkham to see what they were labeled as. And these wallets are essentially vaults, right? If you think about what leverage looping is, you could do it manually, where you take the LST, borrow ETH, convert that into LST and do that loop again. But a lot of people are just doing this automatically through vault programs. So for example, the top wallet is EtherFi's vault product, right? So that basically just abstracts all the looping in the background, and you basically present it to the user as high yield ETH product.
Okay. And I am curious too. I mean, before we move on to Luke, you did contrast like this setup with Morpho, which is a bit more segmented. Can you maybe expand on that a little bit more and sort of think about design choices that might impact the way DeFi looks in the future?
Yeah, exactly. I think we'll get a little bit more into this in the end, but the meat of it is that you have a pooled option, which is Aave, where each asset can be borrowed and you're not choosing what assets you can be lent again, right? So if I'm depositing ETH in the pool, any user with a health factor who has deposited collateral can borrow that ETH. I cannot say, for example, I'm not comfortable with a looper borrowing my ETH. I want to make that available only to someone with BTC or USDC. On Morpho, you have this extra layer of customizability where you are able to choose what assets are allowed to borrow your collateral. But the reason that we saw this do so well on Aave versus Morpho, like the looping trade has been very concentrated on Aave, is just because when you have this one risk parameter that's shared to the entire pool, you're essentially forcing each ETH lender to opt into the system. And now you have billions of dollars of ETH TVL that's compounded over the years. And the risk team has just made that available to be borrowed at a low interest rate for loopers, right? So you have a lot more liquidity and lower interest rates on Aave, which is why the trade has just flourished over there.
Yeah, and it's interesting because it's always that debate between sort of like security and then also, I mean, this isn't the same thing as cross margining, but it's the same concept in my mind. I mean, on my show last week, we were talking about how some people were sort of like leveraging some of the market neutral like basis trades on commodities on platforms like Hyperliquid because there were so many mismatches they could exploit that don't exist now in, I guess, quote unquote traditional crypto, but they were limited in how far they could deploy because they couldn't cross margin and like they couldn't pool their capital together. And it's the same concept here. It's always that give and take. All right, Luke. So let's turn to you. I want to get into Aave's response to all of this because they acted, I guess, somewhat quickly. They were they froze rsETH reserves. They also sort of cut certain parameters to keep things in place. I mean, what did they do? How quickly would you say that they acted? What did the response time look like?
Yeah, so there are definitely a number of different steps in their crisis response process. The first one was freezing the rsETH market, which occurred 85 minutes after the exploit. All things considered, I think that's fair time for the freeze. You need to coordinate, I believe, a 5 of 9 multisig. And also the exploit path made it, I guess, difficult to catch at the mint event because the attacker didn't need to manipulate in Oracle or in AMM at all. Like they minted the unbacked rsETH through the layer 0 bridge, but kept the Kelp's LRT Oracle on the native mint contract kept reporting the pre-exploit rate. So because the forged mint,
I was just gonna, I mean, just for again people that are not entirely up or haven't been in the weeds on this. I mean, basically what you're saying is that Aave systems were not breached in any way, and there was no, I guess, realistic expectation of Aave knowing that the rsETH that was minted on mainnet was uncollateralized.
Yeah, correct. The exploiter was able to deposit that collateral and take out the loan against it within minutes. And by the time that loan is originated, the loss is pretty much already crystallized. So freezing the market prevented new exposure. But of course, the amount of bad debt that's defining this event, they would need to respond within seconds to have been able to prevent that.
Yeah. And I mean, I guess this is a silly question, but I mean, new exposure, as far as you can tell, they were able to essentially borrow against all of the fraudulent rsETH that they minted. I guess any new exposure would have come if they tried to do the whole exploit again and had to mint more, correct?
Correct. Yeah.
Okay.
And I believe during the exploit, the attacker tried to run a subsequent exploit transaction that the second one was blocked by the DVN, but the first one went through successfully. And after that, the exploit was good to go.
Okay. So let's talk, let's kind of expand and talk a little bit about the bigger picture here. Because there's a lot of moving parts. There's a lot of people that are at risk to varying levels. I mean, right now, Aave is, I guess, short almost $200 million of wrapped ETH. And the real question is going to be, who's going to end up holding the bag? Who's going to have to pay for it? Because it has to be made up somewhere. From what I can tell, kind of ironically, KelpDAO is sort of the kingmaker. They can sort of choose to socialize the losses across all holders, across like L2 participants on Aave as well as mainnet ones, or they can choose to sort of localize or limit the losses to the L2 and make all of the mainnet holders whole. And it's kind of, there's some really interesting dynamics here, because on one hand, like maybe it would make sense. Yes, let's make all of the mainnet people whole. They did not realize that they were taking on this risk. And that's a separate question as to whether or not they should have been made aware and by who. But I know in your report and just some of the other reporting I've seen on this, if they go that route and make the L2 holders take a bigger haircut, that could actually lead to more damaging economics because of the unwinding of the looping trade that would happen because of the full utilization of those pools. So could you please just kind of lay out the scenario right now, like where we stand in the different trade-offs of these choices?
Yeah, absolutely. So resolution of the liabilities across the board is still pretty indeterminate right now. Like external financing solutions can come into play. There's some chance that attacker funds can get frozen or reclaimed and attributed to affected parties, perhaps like what we saw with the Arbitrum freeze. But right now, Kelp kind of has this decision that Llama Risk laid out in their governance post on the matter, where they can basically socialize the losses across all holders of rsETH across all chains, or they could choose to just isolate the losses to the layer 2 instance. And what you see in scenario 1 is if they socialize the losses across all rsETH holders, that'll look like about a 17% markdown. And a huge share of that collateral exists on Ethereum mainnet. And there's still some looper equity that can offer a cushion to take those losses. But also a 17% markdown is much less than what you see in the isolated L2 instance, where certain markets could take a much more material markdown and completely blow through any equity cushion, and lenders would take a much bigger impairment. What we also have here is the umbrella module, which is constructed to be junior capital to take first loss in the event of bad debt. And this is the first kind of.
I just want to, I mean, again, just to clarify for readers, the umbrella, I guess, component is sort of Aave's rainy day fund. It's supposed to be the backstop when something like this happens. But from what I can tell, and I think what you're about to explain, is that it's insufficient to cover the debt in this particular case.
Yeah, so I guess once Looper's equity cushion is exhausted, as opposed to impairing lenders, the umbrella module exists to cover that bad debt. So lenders can basically stake to the umbrella module to receive an additional risk premium. That's historically been about 2 to 4%, depending on the asset type. And and they put up that capital to take loss to cover any bad debt. And this module has attracted about 370 million in deposits. It was sitting at its target of 250 million going into the exploit. And this seemed like a really nice cushion in the context of the historical bad debt Aave has realized, which was less than 5 million throughout its history. So of course the 250 million pile seems adequate. But what we see now is it's quite undercapitalized to cover the left tail scenario of a large exploit in an underlying collateral listing. And it's quite likely that in the event of scenario one and losses are socialized across all rsETH holders, the close to 50 million in the ETH umbrella module will likely get wiped out. That being said, it would reduce the impairment on ETH lenders from about 1.5% down to 0.6%, but still inadequate to cover all the potential losses that are in play right now.
And those losses come from the fact that sort of the looping positions that Chandra pointed out. Like interest rates are surging, their positions are increasingly underwater. They have to kind of get out of these trades as quickly as possible to pay back their debts over and over again, and there's just no way to do it. So despite the fact that this number seems bigger than the total nominal size of the loss, the actual losses to traders that would have to be made up from this bad debt will be orders of magnitude bigger than the amount that's in this umbrella module. Am I interpreting that correctly?
Yeah, not quite orders of magnitude, but certainly insufficient on the margin. Okay. So most of this bad debt will come from the rsETH markdown, depending on which scenario Kelp chooses to go with. But back to Shanda's point about the scale of the LST and LRT looping that's going on. Historically, those were positive carry trades. Call it, there's 50 basis points, 1% positive carry, and traders would leverage that 5 to 10x, whatever it might be. But following the exploit and the freeze of the rsETH market, and utilization on ETH went to 100%, interest rates on the borrow leg of that strategy went to 10%. So what was positive carry went to perhaps -7% napkin math, and that's leveraged multiple times. So there was the risk that looper equity, even on positions that weren't exposed to rsETH, looper equity would get wiped out, health factors would crater, and more liquidation flow would come to the ETH market.
Yeah, it's everyone's probably thinking about historical precedents in crypto and otherwise. It reminds me a lot of sort of like what happened to LTCM back in the 90s. I think when they got caught on the wrong side of, what was it, like the Asian financial crisis or something like that, because they levered up on, what was it, treasuries, and eventually they just got caught on the wrong side of it. Okay, and then one other component, again, I want you to walk us through, because it kind of gets a little bit into the weeds, but it is relevant in terms of how some traders are going to absorb losses and try to get out of their positions, is that depending on what happens, there's going to be a haircut on essentially Aave's deposit tokens for wrapped ETH, Aave, and they have the deposit version. They have that for every single token that they offer, but the WETH ones are the ones that are of note here. So can you just briefly explain how those work and how they factor into all of this?
Yeah, so the ETH deposit basically functions as a loan. Points in time, it looks like a demand deposit. You can take back share of your principal. You're being streamed the yield, and it's considerably liquid. And the value of that loan position would track near a par value of 1 WETH. And lenders, they expect a degree of liquidity under normal market conditions. But when utilization goes to 100%, there's basically no available liquidity for lenders to withdraw. And while they were being compensated maybe 10% at the first signs of stress. What governance did what Llama Risk did in the initial crisis response was they lowered that ceiling rate down to close to 3%. So basically, lenders in the ETH market were facing this risk of impairment on loans that had gone completely illiquid with indefinite duration, no defined maturity, and the risk premium they should be receiving under conditions like that, they were not being compensated for. Their yield had gone down to about 3%. So what's happening now is there's the risk to impairment on these loans from the bad debt, and the rates aren't elevated enough to incentivize new suppliers to come into the market and harvest the risk premium. So 100% utilization is basically just a symptom that this market isn't clearing.
Okay. All right. All right. So we've kind of set the table of what happened. We're going to take a very quick break so we can hear from some additional sponsors, and then we're going to come back and talk about what's likely to happen next and what this means in broader terms for crypto and DeFi.
If you've been loving Bits and Bibs, don't forget that the show is transitioning to its own feeds on X, YouTube, and your favorite podcast player. If you're not already subscribed to Bits and Bibs on its own channels, go there now and hit that subscribe button so you can keep up with our twice-weekly live streams and Macro Meets Crypto breakdowns. Bits and Bibs will only be on the Unchained feed for a few more weeks, so subscribe today to be ready for launch. You can get all the links at unchainedcrypto.com/bitsandbibs.
All right, welcome back. So Carlos, let's turn to you. There's a lot of big questions that need to be answered, and we're going to get to that. But before we do, I mean, I'd like for you to just give me your sense of it's probably hard to predict exactly what's going to happen, but what are the different avenues available to a resolution? Talked with Luke about, I guess, some big decisions that KelpDAO will have to make in terms of who's going to take the haircuts. But from Aave's point of view, I would imagine they're talking to all their different partners. I mean, they're looking to find capital backstops, maybe raise additional funds, bring in other market makers to try to help those markets clear and get them started again. Like, I'm sure Aave is very busy, but if you were part of Aave, what would you be doing right now?
Yeah, for sure. I think they'll be talking to all the partners and all the parties involved in this incident to try to come to the best resolution that affects the least amount of parties, or like gets. I think their top priority right now is just have made the users whole on the lending protocol, and I'm confident that they will be able to do that. However, it does set a precedent in the sense that what was the risk management going into this incident, and are you better off like having external risk curators or external risk contributors, or just curating that risk yourself? And I think that's one of the questions that we'll be going into like in the coming months and weeks.
Yeah, it's kind of interesting. I mean, we can't talk about this hack without mentioning the drift hack that happened. What was it, like a week or two ago? I think Tether stepped in to try to help recapitalize drift to a certain degree, and that led to some interesting dynamics vis-a-vis Circle, which we'll actually get to in a minute. But I'm wondering if there's going to be sort of a white knight in here to save the day, or perhaps are they going to try to issue more tokens or change fee structures to provide additional rewards to people who stay with them? I mean, this goes all the way back to, I think, to the Bitfinex hack from like even 2016, where they essentially minted an IOU token that they bought back at a certain period of time, despite I think which was questionable legality, for lack of better terms. So, I mean, could you expand perhaps just a little bit further and the kind of what you think, or? Yeah, please.
Yeah, I don't think we'll see a new like token to make like users whole. Perhaps Luke has better like suggestions on this, but I do not think we'll come to a resolution of that sort of like nature. I do think an external party may come in and make everyone whole, but I don't think we'll see a Bitfinex like resolution where you see a new token.
Okay. And I mean, this might seem like, again, a silly question, but do the three of you have any doubt that that this wasn't Lazarus, or is it pretty much 100% certainty from your perspectives? Okay.
I outsource my on-chain forensic work to a lot of people on the timeline, and right now it seems like consensus is very much so.
Lazarus,
yeah.
Yeah, our friends in North Korea. Okay, so I mean, what do you think this means in the bigger picture? I mean, we have this, we have Drift. I mean, over $500 million has been stolen. I would imagine they have armies of people kicking the tires on every smart contract there is out there. Do you think this is the end, or do you think we're going to be seeing more? I mean, from their perspective, hitting these two exploits back to back, I mean, and they're very different. They must know that everyone in crypto is now going to be testing all of their systems and trying to figure out the best ways they can to rate limit and protect themselves. Even on the assumption that perhaps, I think best cybersecurity hygiene is to assume you will get hacked at some point. So you need to find a way to mitigate it. Like, is this the opening salvo, or is this the end? What do you guys think?
I think there are two things here, right? So first is the risk management side on their rsETH contagion. So Aave scaled to $75 billion in deposits, essentially using the same unified pool architecture that was proposed by Compound back in 2018.
Mm-hmm.
I would say that there is nothing inherently wrong with the unified pool model. The model has been incredibly successful. It bootstrapped deep liquidity. It enabled permissionless borrowing at scale. The problem is when protocols start moving down the risk curve and a more complex collateral. So unified pools work best when the collateral set is restricted to a small number of high quality, continuously priced assets such as BTC, ETH, USDC, and USDT, where the primary risks are essentially just volatility and liquidity that can be modeled with loan to values or liquidation thresholds, right? Spark is actually a great example of this, where they do have a unified pool model, similarly to Aave, but they have very conservative approach to risk management and a tighter collateral set. So they listed rsETH back in January, and they have seen almost $2 billion in inflows since the Kelp incident. So on the one hand, you do have like the risk management that can prevent this sort of contagion. And to your specific question, or are we in a period where attack surface of DeFi has meaningfully like expanded? I do think that as systems become more composable and fragmented, the attack surface expands. What's funny or like sad to me is that I think we continue to see the same attack vectors that we saw 5 years ago. So it's all bridges, it's always oracles, RPC infrastructure, risk-taking wrappers, etc. So from that point of view, I think the industry can do a much better job at learning from past mistakes and actually taking security seriously. And the second factor is that I think AI likely accelerates both sides of this, in the sense that attackers can automate vulnerability discovery and exploit simulation much faster, but also defenders can harden systems faster and improve monitoring. So in my opinion, the most competent teams will remain security first and have largely avoided these issues. And an important nuance here, I think, is that Aave itself was not exploited. So this was the contagion from the collateral impairment in one market, not a smart contract exploit on Aave itself. So that's where I say that the distinction matters between the risk management itself and also the security on the other hand.
Yeah, it's really kind of this conversation, again, to expand it a little further out. I mean, I view it in a different light in the world where we now have, I guess it's called Mythos, that new tool from Anthropic that they're only rolling out to a few selected trusted parties. Although I guess there was a report in Bloomberg that some unauthorized contractor has already gotten access to it. And what does that mean for finding 0-day bugs and how quickly can they be stopped? But it also is kind of fascinating to me that like, both of these hacks, I guess, I mean, the drift hack was more almost like a very complex social engineering hack. I mean, this one perhaps came due to compromises over convenience versus security and sort of on-chain adoption. But I mean, for the most part, I mean, when I look at cybersecurity events, not even just related to crypto, it really comes down a lot to like hacking people. Sometimes it's easier to hack a person than a system. And like I'll hear all the time, like I'll get questions even from my friends and family about all this cybersecurity stuff. And I said, like, worry about like 2FAing your email account and not falling for phishing attacks. Like, don't worry about some 0-day threat that's going to wipe out your bank account. Like, there's more acute things to focus on. And just related to Sparkland, because you do point it out in the report. I mean, they made the decision to remove rsETH back in January. Do you think that they were lucky, or was there a real reason why they did it? Because it certainly seems to be exceedingly good timing.
It's probably a combination of both. They removed rsETH as part of a broader cleanup of low usage markets. But in my opinion, even if rsETH had remained listed in the lending protocol, Spark's losses would probably have been much smaller because of rate limited supply caps and borrow caps. So even if rsETH had remained on the platform, Spark has a mechanism to limit how quickly users can build exposure. So that would have prevented losses of the magnitude that we saw on Aave. Obviously, this is a hypothetical and we didn't see it play out, but that is my view of the risk mechanism.
Okay. So, yeah, I mean, we just have a couple of minutes left. I mean, I want to just kind of broaden it to the three of you. And maybe you could just give me some final thoughts, because this is still a dynamic situation, and a lot still needs to be resolved. And this is happening during some really important times for crypto. So here I guess are two quick questions I have. One, what does this mean for what decentralization means when it comes to crypto? I mean, we talked about our Arbitrum decision to freeze, I think it was like 30 million ETH on their network. Luke, we discussed Aave stepping in, a security council, and I know it was like a 5 of 9 multi-sig decision, but there still was a security council that was able to make decisions that affected everyone in a quote unquote decentralized environment. So what, and this is all happening again, going back to the drift attack, where Circle came under massive criticism for deciding not to freeze the USDC that Lazarus Group took from Drift. So what does, I'd like maybe Luke, I'll go to you for this. Like, what does that mean for, what does decentralization mean to you in light of all of this?
Yeah, I think we're kind of coming to the realization as an industry that like certain functions, particularly like risk management and crisis response, should be perhaps responsibilities that are gate kept to a select few of highly competent and responsible parties that are also easily identifiable, and then in turn liable in the event of an exploit or a mishap, like we've seen recently. So there are certain things in Aave's governance that, of course, require DAO votes and whatnot. But at large, I think the surface area of parties involved is going to continue to contract closer towards centralization and more trusted intermediaries with perhaps more admin control on particular parameters, as opposed to multiple parties having responsibility at the full life cycle of how an asset might be used on chain. So yeah, increasingly looks more like a CDFI approach with trusted intermediaries that are responsible and liable.
Yeah, and that leads to this meta question all the time: like, is centralization binary, or is it a spectrum? I know a lot of people will discuss it as as a spectrum, as long as certain core components are met. But even that can be up for debate. And another just adding in another variable to all this is negotiations for the Clarity Act, because a lot of it's going to turn on how DeFi is being treated. And the SEC is doing its best right now under Paul Atkins to sort of exempt DeFi issuers, DeFi creators from having to register as brokers and sort of go through all of that red tape that like the Charles Schwabs of the world have to go through. But when instances like this happen and you see like a group of people, known or unknown, making these unilateral decisions, that can make that it can make it more difficult, I think, in some degrees to accept that these are truly decentralized platforms, or just requires some more sophistication in delineating between the two. Just one last question, again, because a lot of people listening here, I mean, they're probably Aave customers. They probably either or own the tokens or are engaged in DeFi somehow. Again, none of this is financial or investment advice, but what should people do? They just saw Drift. They just saw Aave. They have tokens that perhaps are at risk. Markets are freezing up. What are one or two things that people should do to try and protect themselves? I'll leave it to whichever one of you would like to share.
I mean, I guess this enters into an existential question for DeFi, in the sense of how can you justify depositing into DeFi protocols when sometimes the rate are not even competitive with treasury yields, yet you run the risk of your principal going to zero overnight. So that's one part of the equation. I think the other is that we'll increasingly see vertically integrated platforms that manage risk end to end, as we saw in Luke's call out. I think Maple is one example that comes to mind, where they distribute the products, they underwrite the risk, and they have a more traditional credit structure when they have legal enforceability and there's a clear accountability, right? So in that case, you don't have the situation as in the Kelp Aave drama, where everyone is just pointing fingers at each other, but rather you have a clear accountability and legal recourse path that you can take for resolution. I think we'll see a push into that from the institutional side of things. I think from the retail side of things, if you still prioritize permissionless access, you'll see the most battle-tested protocols just see inflows. One example that comes to mind is Sky, which is perhaps one of the protocols that deserves a bit more recognition, and it's oddly under discussed or undercovered, but it has been live like longer than any other DeFi protocol like in existence today, and has never had a situation like this. Yeah. So yeah, I think what we'll see is just a concentration towards battle-tested platforms.
Yeah. Actually, I think my very first story I wrote for Forbes back in 2017 was on Maker, and sort of breaking down Andreessen Horowitz's decision to invest, I don't know, at the time, maybe like $16 million in a stablecoin protocol. And I had to explain what that was, and why it made sense to invest in something with the word stable in it in a world of crypto, which was so volatile. Well, we'll have to leave it there. Thanks to Luke, Carlos, and Shonda for walking us through the Aave math and basically where things stand. That's it for Bits and Bips, the interview, but stay right here, because Laura's up next with Miguel Morel of Arkham to trace exactly where the stolen rsETH has moved and whether the contagion is actually contained. And then after that, excuse me, she's going to talk with Griff Green of the Arbitrum Security Council on its decision to freeze $70 million in stolen funds. So stick around.